Alright everybody, welcome to acceleratedmortgagedemo. I'm going to give you a brief overview and I'm going to try to do my best to explain how this program works. Alright, you have a job. What we're used to doing now is we're used to making deposits to the bank, and the bank is going to take our money, which doesn't benefit us at all, and invest it and make money off of our money. What we're going to do is we're going to make sure our paycheck benefits us. Essentially, we are going to be dumping it into our mortgage. And then by paying off our principal on our mortgage, all of a sudden our monthly mortgage payments are benefiting us a little bit more. This is the step on how it's going to work. Get used to this cycle. I'm just going to give a quick overview. The way the accelerated mortgage program works is you're going to have a job. You are going to direct deposit our paychecks right into our HELOC, a home equity line of credit. This kind of works like a credit card. Just think of a HELOC as a credit card. Based off the equity we have in our home. Alright? From our HELOC, the very first day of this program, we are going to dump money then into our mortgage. The second we do that, all of a sudden our interest payments that we have to pay in total goes down significantly because our principal is lower. And every month from here on out, the payments that we're making to the bank aren't as much interest. All of a sudden they're just a little bit more principal. I'll explain that in just a little bit. I'll give a diagram with numbers and it makes a little bit more sense. Okay. Here, what we're going to do is, since all of a sudden our paychecks aren't going to pay for our insurance or our clothes and all our other bills that we have every day, because it goes directly into our home equity line of credit, we are now going to use a credit card to pay off of our credit card to pay these off right here. Yeah, I know it sounds a little risky at first, but trust, we are going to make sure that you do not have any balance outstanding on your credit card. You do not want to get caught paying high interest rates on your credit card. So here we are. We're making payments with our credit card. We are depositing our paychecks into our home equity line of credit, which then our home equity line of credit went to pay off our mortgage. Alright, and now we're using our credit card to pay these off. And as soon as our credit card statement is due, you then use your HELOC to pay off your credit card. I know. So now all of a sudden your balance on your HELOC gets a little bit more. But as long as you are making more money than you are spending, over time your HELOC will get lower. Alright? And we are going to make sure that we can live within a comfortable means. We don't want you to change your life and your style. So if you have a 401k set up at your job, or you want to deposit some money into like a brokerage account for savings or some mutual funds, you can still do that. But just make sure the amount of money that you're living off of right here is less the amount of money that you're depositing into your HELOC, or what you usually would your checking account. Alright, now with our credit card, we are actually going to still be paying our mortgage, and we are also going to, like I mentioned, pay off our bills. And we're also going to be paying the interest that is accumulated on our balance outstanding on our HELOC. Alright? It's a little bit of a lengthy process, and it's reversing what we're used to doing, but it works. Alright, you know what? I'm just going to use some numbers to make some explanation of how this works. Alright. This may be review for some of us, but this could be new for some of us else who don't know exactly how the bank is calculating our mortgage. We are aware that we are paying a bunch of interest every month and a little bit less principal, but let's see it in action. Numbers don't lie. $290,000 is the amount that we owe to the bank, our mortgage outstanding. This is our APR, 5.5. We're going to be paying this for the next 30 years. But since we're making monthly payments, the bank calculates it on a monthly basis. So monthly you'll be paying about 0.5%. There you go. You're going to be paying about 0.5% every single month for 360 times. Alright? So here we go. We are going to have our payment. The bank calculates this basically by taking consideration every single month what is the beginning balance of the principal. Alright, what is the monthly percentage rate? They're going to times that by that, and then they're going to take in consideration how long you're going to have it for, and they're going to come up with a fixed rate of $16.46 that you need to pay for the rest of your 30 years of life. And let's see it in action for the very first month. So we're looking at January in year one. we have a beginning balance of $290,000. So what they do is they times $290,000 by half a percentage, and it's going to get interest of $1329.17. All right, we're going to have our monthly payment of $1646.59 right there. That's constant, that stays the same, and then they're going to deduct $1329.17 from $1646, and whatever is left over is going to go to your principal. All right, so you can kind of get a little bit of the ratios. Out of $1646 that you're paying every month, $1329 is going to interest, $1317 is going to principal. All right, and then what you're going to do is just take this $317 and deduct it from $290, and it's going to give you $289.62 as your ending balance, which is then going to be your beginning balance for your next month in February. Here, I'm just opening these things up so we can see them. All right, so here we go. $289,682 is now our beginning amount of February, and the same thing repeats itself again. We have our balance outstanding, which is $289,682. We multiply it by that 0.5%, that monthly percentage rate, and it's going to give us $1327.71. And then once again, we're going to deduct that from our fixed monthly mortgage payment, and whatever's left over is going to go to principal. And now you can see the increments of these things aren't really moving too fast. I mean, in January you paid $1329, you know, and then all of a sudden you're only paying $1327. I mean, that's like $1 difference. It really is really slow. That is why the bank can capitalize, and they make so much money. And over 30 years, you end up paying double the original amount of your loan amount, your principal. All right, but I'm going to paint a picture here. What if we go ahead and decide to draw money from our HELOC? All right, remember this is $689,682. But what if all of a sudden we decrease it by $15,000 by paying off our principal? Look what happens. All right, all of a sudden our beginning balance for next time is $274,682. It's $15,000 less. So the interest that we pay, this 0.5 percentage point right here, is based on a number that's $15,000 less. So our interest all of a sudden becomes significantly cheaper than it was before. Remember how before it only went down by like $1? Now it goes down to about, wow, I don't know, what is that, like $60? And all of a sudden our principal payment, which they deduct our fixed, it's still fixed, our fixed rate doesn't change. They subtract $1258, but now all of a sudden our principal is $387, where it was $317 before. It goes up by a significant amount. And that is how the process works. So every single month, instead of before, you know, barely getting by paying off principal, all of a sudden your paychecks are working for you. Your monthly mortgage payment, it's almost like jumping into the future about 2 or 3 years, and your monthly payments are working for you and taking advantage of you. All right, now we're going to get into how this $15,000, because this isn't actually your money, remember, this is the bank's money. They let you borrow it. All right, we're going to show you how this $15,000 ends up costing you a lot less than $15,000. Done here is I've made a more full, clear looking picture what's going to happen in 30 years. This is the same amortization schedule. I just showed how it worked. Now let's just see it in full action. All right, remember the $290,000 balance, the principal, the interest, and we remember how these things are calculated. The escrow payment and the PMI are new things. PMI is just insurance that goes to the lender in case your house forecloses and the value of your home doesn't pay off what is due to the lender. The escrow payments is just money set aside to pay off your property tax and insurance every year. And this is just our monthly payment. It goes up a little bit due to these two things right here. Okay, and I also put in dates so we can put like a real time frame on what's going on here. So, all in all, the interest that is going to the bank is $302,000. All right, on a $290,000 loan. Okay. PMI was $30,000, escrow payments was $74,000. Total, you paid almost $700,000 to borrow $290,000. That's why everyone wants to own a bank. All right. So, I am just going to, oops, I already copied and pasted it. Okay, this is what it looks like all in all. And you're going to have your house paid off by on 5/5/2005. So, but let's just say we're a little bit responsible here. We all know that if we make extra principal payments, our house will be paid off quicker. So let's say we're responsible and we budgeted in $200 extra every single month. All right, look how things change. All of a sudden, our interest is only $223 compared to $302. Our PMI goes down because we pay off our equity faster. We pay off our loan faster, so our equity in our home becomes quicker, and we don't have to make so many PMI payments. Because PMI is basically going to be paid until you own over 20% equity in your home. So by paying extra principal, you own equity quicker. Escrow payments is a lot lower because you pay your house off quicker. You actually go ahead and pay your house off by 8/5/2008, so about 7 years quicker. And you can see your overall payments is a lot less, $592, $697. So you can see the difference there. So what I'm going to do is I'm just going to copy and put this over here, so we can now look what it's going to do when we accelerate our mortgage. Alright. Alright, now let's take in consideration that you've had your house for a little while. I am going to jump down into 12/5/2008. Let's say that based on the calculations that the Excel model showed us, we were able to come out with $12,880 that we drew from our HELOC and put right into our mortgage. Alright, and then these numbers are going to be calculated based on how much our HELOC balances and how much we're making money. The Excel function will tell you how to come up with these numbers, as well as this number right here. Alright, but let's look at the overall scenario. The total interest paid now is $218,000. Your PMI is the same as what it would be if you made extra principal payments. The total escrow is a little bit cheaper because you pay it off quicker. We actually end up paying our house off by November 5th, 2027. Alright. I'm just going to put this over here so we can get a side-by-side comparison. Okay. Alright. Look at this right here. I want to kind of focus our attention on here. We made $65,000 of extra principal payments. Right here we made extra principal payments of $55,800. Now, this may look like we had to make more payments to pay our house off quicker, and that's what we did. We made more extra principal payments. But the secret is this right here is not with our own money. This right here was with our own money. Remember, we set aside $200 every single month to pay off. But right here, we're using those float periods, which I briefly mentioned earlier. So I'm going to open this up right here so we can get a little bit of a better picture. Okay, the interest that we had to end up paying on our HELOC was about $7,000. All right, this is actually how much money that we had to spend out of pocket. Going back to the diagram, I can explain it, and maybe it will make a little bit more sense now. And we were able to make that much more extra principal payments. So all in all, this is what our total savings look like. All right. How I got the saving on interest is basically what it was before at $302,771, subtracted how much we'll have to pay when we do our accelerated mortgage. Okay, our savings on PMI is how much our PMI was before, subtracted by how much it is now. Our savings on escrow is what it was before, minus how much it is now. And then I added in the money that we'd have to go ahead and pay on our interest. All in all, we saved ourselves $105,000 of payments that we would have to make on our mortgage. That is how the program works.